Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. The U.S. tariffs on Canada and Mexico have sparked industry disruptions. Today, there is a potential for a peace talk in Europe. We're keeping track of that. Yesterday, President Trump announced he will lower the threatened 25% tariff rate on Canadian potash to 10%. This after facing backlash from American farmers. Things are moving fast. Beyond potash, though, other areas like lumber, metals producers are all feeling the heat. So how are these tariffs and policy overall affecting the materials sector, and which companies are better positioned to weather some of these impacts? Happy to say that joining us here today to break down what's shaping the materials sectors for this quarter, and to the extent we can figure out beyond, is equity research analyst Claire Fleming. Welcome back. Great to see you, Claire.
Great to be here.
Great to have a chance to speak with you. So let's begin a little bit with what we know. Actually, potash, we kind of, as much as you can know anything right now, we sort of know is going to be hit with tariffs of 10%. Tell us a little bit about the potash industry and probably the agricultural backdrop that has led to this decision and really the global story for it.
Sounds great. And maybe just for context too, material sector is broad. So within my coverage group, a lot of that focuses on agriculture and potash, as you mentioned, as well as the copper and diversified miners, forest products, packaging companies, and some other chemicals companies as well. I think when talking about potash and the impact of tariffs on my broader coverage group, maybe the direct impact of tariffs on earnings is not as material as some might expect, but it's more on the indirect impacts where I'm spending more time and focusing a lot of research going forward. So maybe just to clarify that on some of the direct impacts of, and why I think maybe some of those direct impacts of tariffs on earnings might not be as bad as expected. And that's because of the geographic diversification of some assets, some of the foreign exchange benefits, as well as the price response we're seeing in some commodities. So on that geographic diversification, even though I research companies that are listed in Canada, if you think of the copper miners or lumber producers, a lot of these companies have assets that are outside of Canada and not as exposed to cross-border Canada-US sales. On foreign exchange, for some of those companies that have assets in Canada and Canadian labor costs, but sell in US dollars, that weakening of the Canadian dollar is helping to reduce some of their production costs relative to global peers. And on the price response we're seeing in commodities like potash that you referenced earlier on, we're starting to see a gap in US pricing benchmarks compared to some other areas of the world for commodities like copper. We've seen steel prices increasing. Canadian lumber price benchmarks are up 30% for some grades year to date. So we are seeing that price response. I think it's more on the indirect impacts that we are talking about, where we're spending more time for potash and other commodities as well. And that's really thinking about how some of this uncertainty that we're seeing, that we all feel when we see these back and forth headlines related to tariffs and trade, and how that can impact
questions of everything.
Demand decisions. So like if you think of the example, if you're someone who's in charge of running an appliance manufacturing company and you might sell to North American customers, even if you're wanting to expand your operations, you might be putting off that investment decision and sinking that capital because you're just not certain yet as to what that end tariff policy might be. Or if you're that end consumer who's wanting to do a kitchen upgrade, have those appliances that need the copper wiring and components within them, you might feel a bit uncertain about your own job prospects or uncertain about what your life could look like 6 months from now, so you might be putting off some of those decisions. And that ties into the demand outlook for things like copper, as all those little decisions add up. Things like potash demand, I think that's maybe why you're seeing some of that reduction in tariffs relative to the initially proposed 25%, just to help improve that affordability for US farmers that are facing some challenges from the volatility we've seen in corn and other crop prices the past couple of years.
Is potash, so potash is a global commodity, it's priced globally, it has a lot to do with Russia, Ukraine and peace talks there, so we can sort of leave that to the side. But the potash produced in Canada goes largely to where? To the US?
It's sold into global markets. And I think a lot of that does go into Asia as well from those West Coast ports that can help transport product globally. But I think the dynamic between US and Canada for potash is that the US has very little domestic supply. So it's and it's also very difficult to build supply compared to other commodities for potash, given that a lot of that's dependent on geology and it also takes a really long time to develop projects. So I think that could also contribute to some of that lower tariff or price response just because there's very little supply in the US. So in a scenario where there was a higher tariff, companies have been saying they assume a lot of that cost would be borne by the US farmer, just because whether it's coming from Canada or other regions, there's just very little domestic supply in the US for all of the farmland that they have.
So it's interesting that that was one of the ones that was sort of decided or moved on kind of first. And maybe, obviously, that's why and some of the diplomacy that's been moving around maybe has worked. Tell us a bit more about the demand side of things. You went into it there a bit about what a customer or a supplier is going to do in terms of inventory. They might wait, so the demand picture is different. For other commodities, I'm thinking copper right now. It seems like we were talking about forever the supply side of copper, which is a real thing. How do you get more of it ultimately when there is demand? But now we're talking a lot more about demand, it seems, and this is related to the tariffs. Is that a bit of a shift in your research, going from maybe a bit more of the supply to now demand?
I think that does tie into that theme around the indirect impacts of tariffs and how this can impact the demand outlook for copper. Because as we mentioned, some of these companies don't have cross-border Canada-US sales, but I think some of the relative performance has been challenged just by concerns about what this means for global economic growth, since a lot of these end markets for copper, whether they're industrial or consumer related, are really tied to GDP. So I think some of this uncertainty could lead to slight downward expectations to the demand outlook for some of these key end markets. And as you mentioned, it doesn't really change that longer term supply thesis for copper that we've been talking about, where
it takes a long time to build a mine. You have to,
where and very few projects have been commissioned in the past couple of years, so that does still lead to those longer term supply constraints. But if we do have a scenario where some of this uncertainty related to tariffs or weaker affordability if tariffs are passed through could just push out the timing of some of that tightening that people have been expecting in copper markets.
It's really, really interesting. Tell us about some of the sub-industries, which again, I think is where you're seeing the secondary effects that you're talking about. It was a great example of taking a look at appliances, for instance, which would have coatings, which I think you probably follow, lots of copper and other components. What other sub-industries are you talking about? Give us some granularity beyond that.
I think more broadly, too, there's some interesting dynamics going on in the lumber industry that I feel like this has been an industry that comes up a lot in the headlines, both with more recent tariff announcements as well as the ongoing softwood lumber dispute that's been subjecting this industry to some form of duties for longer periods of time. And I think that's one where it's been interesting to see, supporting that price increase in some benchmarks I mentioned. There's maybe a price response to some expectations around tariffs. There has been a supply response over the past year in the industry, just from the impact that higher rates have been having on housing-related demand in the US. Some companies have said they think about 10% of capacity was announced to be curtailed last year. But this is another industry that, again, that focuses on the indirect impacts if there is uncertainty from consumers about the forward outlook, maybe that impacts repair and remodel related demand. Or if lumber prices are higher, passing through these tariffs, kind of similar to that repair and remodel outlook, maybe customers still want to go ahead with projects, but it doesn't seem as affordable. And that could tie into the demand outlook as well. So there's a focus beyond just understanding that initial ability to pass through a tariff or what the price response could be, making sure we're spending time on the demand outlook too, and just iterating our forecasts to make sure that they're aligned with what that current outlook looks like.
It sounds like a lot of people modeling are taking a look for certain things at COVID, where it was a time where we sort of had to shut things down for different reasons. Is some of the modeling that you're doing, and I want to get into the team and the teamwork that you're doing, is it drawing on some of the supply crunch that we saw through COVID?
I can give some broader context on what that internal process looks like and how we build our models, especially for a commodity group. I think a big part of the research process for materials is maintaining your own supply-demand models for some of those key commodities like copper, lumber, potash, uranium, and really being able to put your own assumptions in around what you think that demand outlook looks like, what you think the supply outlook looks like, and I think it's great having my own models, because then when things are changing, you feel confident about updating those assumptions quickly, having your own view on things when the situation's evolving quickly, and being able to create your own scenarios. And as an analyst, what I really focus on and try to tie into my conversations with portfolio managers is making sure there's consistency between what those supply-demand models are saying and how that ties into how I'm forecasting commodity prices, earnings forecasts, the valuation outputs for companies, so that we can have a view on risk rewards. So for some of the commodities where you think that there's more visibility on supply growth over the next couple of years, maybe that caps how you think about the upside to pricing. But on some of those commodities where you do feel like there's longer term supply constraints, or you have a different view on demand, you just want to make sure that you're updating that price deck and inputs about commodity prices to make sure that that industry research you're doing is aligned with the outputs that portfolio managers are seeing and using to help make their portfolio construction decisions.
It's fascinating. The companies broadly, you went to, I think, a conference, you said, a big mining conference. There's a lot of conferences going on right now. What was some of the chatter there from companies, people in the industry themselves? Is it, there any particular themes that came out to maybe give more context to the moment we're in?
You're right, it is a busy period for conferences now that Q4 earnings results and outlooks are out. As you mentioned, I was at a mining conference as well as a chemicals conference last week. A lot of my colleagues are also out at conferences for their sectors and coming back with takeaways. And I find these global conferences really helpful for my research process, because even though I'm only researching the Canadian listed securities, especially for industries like copper that are so global, just getting context from all of those global peers and being able to reconcile what they're saying about the global outlook with what companies in your coverage group are saying can be really helpful for the research process. So I think there's maybe 3 kind of higher level themes that I focused on in some of these meetings, and I think they're related to global supply, M&A, and the organic growth outlook for some of these copper companies. So on global supply, I think it's interesting to see that we are starting to see some assets stabilizing a bit, and that of course there can always be some unexpected challenges, but you might have remembered as we were coming out of COVID that a lot of companies had delayed some of the maintenance work on projects just because it was so challenging getting the workforce on site, and also there was so much volatility in sort of wage inflation and labor availability for some of these projects that created some interruptions too at mine sites. So again, it's an industry where there's always some disruption, but we are starting to see that disruption, I think, stabilizing a bit compared to all the volatility we saw over the past couple of years. On M&A, maybe to follow up on that as well, I think it's an industry that's always consolidating, or it's historically there's been a lot of consolidating, but some companies are saying that just based on where valuation multiples are at, it's a bit tougher to find that value for really large-scale acquisitions of producing assets. It's not to say it's impossible, but there's some challenges to seeing like the returns on valuation. I guess I'm speaking more about larger cap names for kind of those transformative combinations, which I think is starting to create more of a focus on the organic growth pipelines for copper and what companies are doing with development projects. Because if they can't see that valuation in publicly traded companies that are already producing, there's a focus on trying to evaluate growth pipelines and seeing where they think there's the potential for relatively attractive development projects over the next couple of years.
So this would be companies that perhaps have already announced that they're going to, have bought the land or whatever, and are going to develop by X date, and they might move them forward, that type of thing?
I can give some more context on what that pipeline's looking at like for companies. And I think like one really interesting area is in Argentina, where there's been a lot of change over the past couple of years. Like this is an area that's always had a lot of copper resources, but just it was challenging to get visibility on the policy outlook in that region to feel comfortable committing capital. But they had a really big policy bill announcement just last year called the RICI bill that gives really strong incentives for capital investments that meet certain criteria. So you're seeing a lot of companies that maybe had deposits or projects in the works there for long periods of time, suddenly thinking this might be a bit better window. and trying to accelerate some of the development work they're doing to see if they can get projects sanctioned in a time frame that would allow them to benefit from some of these incentives on projects. Right. I think in the US as well, again, like project development is a very long process, but we are starting to see with such an increasing global focus on access to critical minerals and resource security that there is increased interest in potential projects in the US and questions around could the permitting process start to look a bit more open or straightforward than in the past. Again, there's lots of different stakeholder groups, sure, lots of asset-specific considerations, but you think of some of the larger mines like Resolution in the US or deposits that have been in news flow for long periods of time, and there've been controversies around some of these assets for sure, but there's questions around could this be a window where discussions start to pick up again? There's a bit more visibility on asset growth in regions where there maybe has been more historical challenges with either the permitting or policy outlook. So those are a few examples.
Those are really good examples, and it sort of speaks to the deregulation story, if you want to sort of have that lifted slightly. What should we think about certain distortions as we watch the global prices for various commodities? Again, going back to copper, there was some notes about how much copper is sitting in warehouses on different sides of the ocean. What's actually landed in the U.S., therefore has already paid its taxes and won't get tariffs, and what still wants to get in the door before the tariff story. We see this in trade numbers. Lots of things have been pulled forward, be it retail, materials, and all kinds of things. What of the price distortions? Is this a moment just to kind of sit there and kind of wait till this all shakes out, or is there anything that investors should know about those moving prices?
I think there are, as you mentioned, some distortions or changes that we're starting to see with US pricing relative to some global benchmarks. I think depends on the situation, but in commodities like copper, it is a bit tougher for companies in my coverage group to take advantage of some of those distortions in US pricing relative to the rest of the world, because if tariffs are applied, like they wouldn't be able to realize that higher benchmark pricing in the US. So that is a benefit for companies that already have assets there, but tougher for companies in my coverage group to always be taking advantage of some of those differences in global pricing benchmarks. And as you referenced, I think it'll be really interesting to see going forward, like sort of what that underlying demand for certain goods is, because like China's export numbers were really strong in Q4 towards the end of the year, but it's hard to break out exactly yet, like how much of that was underlying demand, economic growth, and how much of that reflects a timing shift in the purchases of certain goods contributing to that. So as I mentioned, I think that ties into the focus going forward on continuing to iterate on those demand models for certain commodities and just understanding that forward outlook, whether any of these price distortions could reduce affordability and demand for certain commodities or create risk to economic growth that also cause revisions to the demand outlook going forward.
You're modeling all of this, you're staying on top of it, you and the team are doing this. There have been lots of earnings reports. Earnings have been fine, actually, but it's the outlook that everyone's looking to, which no one really knows what the outlook is. So it's really tough. Is there anything that you would do to just kind of sum up what you're seeing in earnings and maybe specifically on the outlook side of things? Is there anything that you take from it, or is it a bit of a wait and see?
It is I find very interesting for commodity companies where there does tend to be fewer surprises in earnings compared to some other sectors, because you've been monitoring the changes in pricing benchmarks throughout the quarter. And as well for Q4 results, a lot of mining companies pre-released their Q4 production numbers and gave guidance a bit early on in the year for how they're thinking about CapEx and production. So it did result in fewer surprises, maybe compared to some other sectors where they might be announcing more material changes to their forward outlook and how they're talking about demand going forward. I think the focus for a lot of these companies, though, and what's the work being done on a bottoms-up analysis is really focused on that forward outlook. And as I mentioned, if we are going to a scenario where demand could be a bit weaker and that starts to change the pricing outlook for certain commodities, that's where as an analyst you're going through and scrubbing balance sheets again and seeing which companies have more balance sheet capacity than others to withstand a slowdown, or which companies have better positioning on the cost curve, or which companies are already trading closer to your view of a trough and you think don't have much downside and that you maybe think PMs could hold for really significant returns or upside on a multi-year basis. So again, there's still a pretty wide range of scenarios that could happen, and PMs have lots of different styles and ways of approaching it, but that's kind of as an analyst what you're focused on, understanding the balance, looking at the updated balance sheets, and doing that bottoms up work so that your scenarios are ready and can help support decisions.
So going to that really strong longer term outlook and what that might mean, there's been an awful lot of talk about, a new era of infrastructure being built in North America and in other parts of the world as well, but a focus on needing to update all kinds of things, including data centers, including building new, including perhaps dusting off old nuclear stations. I mean, there's a lot of moving parts to sort of this new reindustrialization. What role in everything that you are looking at right now is that this is going to play a huge role ultimately in sort of a longer term build out and a reindustrialization? Just take us through sort of what we need to get through to get to that, or is it already starting?
Maybe I'll just pick one sub-industry to focus on
and
kind of talking about the longer term implications. Otherwise, we might take up the rest of the half hour trying to get through all of my groups, but maybe we can focus on uranium, because I feel like that's the industry that often comes up the most if you're talking about implications of AI on my group, or which companies could see the most material potential changes to the outlook if there's increased power infrastructure to support increased AI usage over time, and nuclear often comes up in a lot of those discussions. And I think the uranium industry is at an interesting point in that if that scenario does go ahead and there's a lot more power demand over time, there's really great optionality compared to how a lot of people historically thought about the sector. But there's also some near-term protections for the industry, like related to the supply-demand outlook. Like how we're talking about other commodities where demand can be a bit more cyclical. I think in uranium, it's not as cyclical, and you can often feel like you have more visibility on the near-term demand because that's driven by how many global reactors there are and power usage.
And you can count those up.
Yes, you can look at the data there and kind of make your assumptions about intensity levels of how much uranium is needed, and that kind of that's how I build a demand forecast for uranium near term. So you feel like there's a bit more visibility on the near-term outlook, independent of AI adoption, small modular reactors, all of those things that come up in the headlines. And on the supply side, of course, Canada is a big producer of uranium, but Kazakhstan is another key region that often comes up. But in the past couple of years, they've really been having challenges with sulfuric acid availability with their mining process. And
which you need for
them, they need that to help get the uranium out of the ground, to simplify it.
That does simplify it.
And they're working to build more capacity of sulfuric acid by 2027, but clearly that's still a few years out. In construction of any sort of chemical plant, there's always risks with exact timelines, which makes it difficult for them to accelerate production in the near term. And I think, of course, Russia often comes up in the discussion on uranium as well, but it's they do, of course, have some a greater share of enrichment and conversion capacity further down the value chain. But if you think of where the actual commodity exposure is, a lot of Russia's like primary U3O8, they call it, like the upstream commodity, is produced through these joint ventures in Kazakhstan. So similarly, they've been exposed to some of these supply constraints on production in the region that seem tougher to sort of flip a switch or see change, even in a scenario where there is progress on some of these peace discussions between Russia and Ukraine that have been coming up in the news a lot more often recently.
What is moving quickly in terms of, well, the demand picture? I guess it's really the tariffs is the thing that's moving quickly, because everything else has its own timeline in terms of how long it takes things to get up and running, or to add capacity, or to switch gears, basically. Will a fortress North America, if this is what's being aimed at, and we don't know that it is, will that change the whole discussion of sort of supply lines and where things are being sold, or will the global price always be the global price? I mean, we're seeing so many distortions right now. I'm just sort of curious what you expect going forward for sort of the global price of pretty much anything within your industries.
I think at this point, more of the focus on setting some of those longer term price decks is more supply demand driven, and tougher to take a view at this point is exactly what pricing gaps could emerge between different countries or alliances for certain materials. Right. So in my view, I view that as a source of potential optionality if increasing Western demand for certain goods creates higher prices or more of a willingness to pay. But I think it's a bit too early to be pricing that in to some of the longer term price deck assumptions and being willing to pay for that in company earnings or assumptions. So I think the focus is on having that longer term supply demand view that gives you more of that bottoms up confidence in your price deck and earnings assumptions over time, while also being mindful and continuing to monitor things that change, as I mentioned on the supply side, if some of this increasing Western demand for critical minerals and a focus on Western supply chains eases permitting processes or other sort of levers, like maybe that creates optionality for companies that have development or earlier stage projects. So continuing to monitor that side of things, but feeling that it's a bit too early to be making a longer term sort of pricing spread assumption on some of these key commodity benchmarks.
There is a place, let's get to actually a couple of these questions. I think you've gone through a couple of them, but I'll just add to a question about Ukraine. If people will model Europe on, it goes from, quite bad to less bad. And I guess there's a question there for if there is a peace dividend, basically, for companies that are either exposed to or related to commodities that are in Russia and Ukraine, and peace would create a bit of a bounce for some of the stock prices for certain companies, depending on how exposed they are to that. Are companies in Canada exposed to the peace discussions, basically? Is that something that you watch?
There's a few connections to maybe speak about. And as you mentioned, if there is a rebuild of Ukraine, and even more recently with some of the announcements we've seen in Germany just this week around stimulus or European investment, like that could be positive for certain areas of commodity demand. But I think on commodities, the Russia-Ukraine discussion often comes up more on the supply side and cost curve of commodities. And I think on the supply side, the direct impact of that might not actually be as material as some people expect compared to when we would have been having discussions at the onset of the war, and there's discussions of, we thought like, the potash would be like really constrained because it's such a material producer. And I think what we've seen over time is that a lot of those trade flows shifted. So a lot of Belarusian potash has been going to China by rail instead of some of the other more Western customers that might have been accessing it through the ports prior to the conflict. So there's been more of a shift of trade flows and not as much of an absolute supply disruption as people expected. I think the one region in Belarus too, it's unclear, since they had some sanctions on their logistics and potash prior to the onset of the war, it's unclear if all of those sanctions would be lifted, even if there were what was a situation that led to peace in Russia and Ukraine. I think it's interesting, though, how we talked about sort of direct, indirect impacts of tariffs. I think direct, indirect implications of a peace scenario comes up for my group as well. And one of the less obvious implications, I think, about a peace scenario on the earnings of companies in my coverage group is if a peace scenario leads to lower European gas prices, which of course is positive for a lot of industries, but I think it is more challenging for some of the North American chemical producers, whether they're commodity chemicals or things like nitrogen fertilizers, where over the past couple of years, they've been benefiting from the wider spread between US and European gas costs because they've had relatively lower cost of production here in North America, and the higher European gas prices have been pushing up the cost of production in those regions and then industry pricing for some of these chemicals that use natural gas as an input. So there is a view that if you do have a peace scenario, or other drivers too, like the increasing LNG import capacity in certain areas of the world, that those could be deflationary for certain industries that produce chemicals with natural gas, and that could narrow the relative margins that we see in the global chemicals landscape between companies with North American assets and companies with a larger European asset base.
Oh, that is absolutely fascinating. Okay, that is amazing insight to give. If you were to just sort of wrap up your coverage universe with just a sentence or two, what would it be? What are you sort of keeping your eye on right now that you want to share with investors?
I think the most important thing to know about the material sector is that it's really volatile periods that can create great investment opportunities for portfolio managers. It's really tough to take a differentiated view or add a lot of extra value when things are going well, all the companies are doing well, valuations are really extended. And I think it's sometimes in periods where there's a lot of uncertainty and volatility and companies get more discounted to reflect that you can see really great opportunities for portfolio managers to step in and build positions that can have a really outsized impact on client returns a few years out.
Fantastic. Claire Fleming, a delight to see you and to speak with you. Thank you very much for bringing us up to date on everything that you're watching so carefully.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.